Aaron, what is private infrastructure?
So private infrastructure is the attempt to make infrastructure investing available to the wealth management space. The origins of infrastructure investing go back many decades. In fact, historically, infrastructure investing has happened at the government level. Seaports, airports, toll highways, those are the types of projects that many decades ago were only done by governments. And then what occurred was governments realized that they could access investment dollars and share equity ownership in these infrastructure projects. So they started accessing investment capital, usually from pension funds. Any long-term investors that had multi-decade time horizons and had huge access to capital and were comfortable with the lack of liquidity in those investments. The innovation that's happened more recently is to try to expand that offering to the individual investor through private infrastructure funds.
And Aaron, how has infrastructure investments changed over the years?
So the key change that has happened comes down to the requirement to achieve a greater liquidity, to make it available to individual investors. And the primary way they have achieved this is by expanding the definition of infrastructure investing to include types of projects that happen have a higher frequency, have a shorter time horizon, and are more liquid.
And how are these investments different from other private alternatives?
So this is the tricky part about infrastructure investing when you look into an infrastructure fund. And this is not to say that infrastructure funds are necessarily bad in any way. It's simply to say that when you look inside of the infrastructure product, often you'll see investments that are also defined as private equity or private real estate. You'll also sometimes see investments that are, often considered more like utilities, public utilities. So when you're incorporating infrastructure into your investment portfolio, you need to drill down into that specific product and understand if there's already some overlap in other areas of your portfolio, so that might just be creating some redundancy.
And why would I incorporate a private infrastructure fund in my portfolio?
So what private infrastructure attempts to achieve is to produce some resilience against the economic shocks that can occur around specifically inflation and recession. So imagine a toll highway is not particularly sensitive to a recession. The cash flows, the number of cars traveling down the highway is going to tend to be quite similar in both parts of the economic cycle, and the pricing of that cash flow is generally determined in a regulatory environment. Also, infrastructure investments tend to be quite resilient to inflation, meaning that if there's a devaluation in a country's currency, there is an inverse correlation to the value of that infrastructure investment that will increase over time. So essentially what you're trying to do with an infrastructure investment is to create some greater diversification away from other parts of your portfolio that are more sensitive to economic shocks.